I'll be presenting on financial management. An estate agency enterprise is expected to keep and maintain accurate financial books, records, and statements in respect of both business and trust accounts, and maintain an accurate and accessible filing system to facilitate the tracking of relevant financial documents, including, for instance, accounts received and paid, invoices and checks issued, bank statements, and their similar documents. While each individual enterprise must determine which of the available record-keeping system best suits its own specific characteristics and needs, it is evident that the success of any estate agency accounting system depends on a good system of internal control. This CPD presentation will, however, be focusing on the income and expenditure statement and the balance sheet and cash flow statement. Acceptable measures of financial control for an estate agency enterprise include, amongst others, properly numbered and correctly dated source documents, control accounts for clients and trust creditors, the maintenance of permanent asset registers, opening and maintaining separate trust and business bank accounts which are correctly designated, and as such, the control of receipts, deposits, and maintaining and balancing a petty cash book. Keeping an accurate analysis of income and expenditure, performing monthly trial balances to ensure that all accounts are properly balanced in terms of Section 32, Sub 3, Sub B of the Estate Agency Affairs Act, which obviously requires estate agents to balance their books and records at intervals of not more than 1 month, and performing monthly reconciliation bank accounts. Next, we're looking at internal control systems. An estate agency enterprise should have appropriate internal control systems suitable to their individual methods of operation. Internal control systems generally include such aspects as segregation of functions and duties, so that, for example, a person who issues receipts does not also record those transactions in the cash receipts journal. Properly defined authorizations, so that, for instance, a person whose function it is to manage electronic funds transfers do not also have password for the actual transfer function. Efficient control over numbered documentation and efficient supervision of employees. Enterprises should consistently compare budgeted figures against actual results achieved. Material variances apparent from the analysis must be fully analyzed and suitably adjusted. Financial figures for previous years should be compared with the results of the current year. Now, next we look at maintaining accurate and complete financial information. Care must be taken to ensure financial data is accurate and complete. It is both dangerous and irrational to base vital business decisions on erroneous or incomplete financial information. Inaccurate financial data may result in, inter alia, incorrect decision-making, diminished productivity, increased employee turnover, alienated customers, and lost sales. Available financial data must be comprehensively analyzed to ensure that it is accurate. A reliable data quality improvement plan should also be devised. The inherent problems are caused by inaccurate and unreliable data must be recognized before they can be addressed. Once the extent of the problem has been determined, consideration can be given to resolving it. On a cost-benefit analysis, the cost of correcting the problem of inaccurate data are likely always to be less than the cost if the problem is not timeously resolved. Backup financial data is what we're looking at next. A backup file is a copy of the actual data file. Backup files are used where the original data file has become unusable due to, for example, hardware failure, human error, software corruption, computer viruses, theft of hardware, and hardware destruction. Financial and other costs of lost data are huge, and estate agency enterprises must institute the necessary measures to protect this vital organizational resource. Financial data should be backed up to removable media, not stored on the computer hard drive. Updated backup files must be maintained in a safe location away from the business to ensure that in the event of an unforeseen catastrophe, the financial data is safeguarded and remains intact and accessible. In most data loss cases, it is found that the lost data is either recoverable or partly recoverable, probably by using an expertise of a data recovery specialist, or permanently lost, in which event the data must be retrieved and or re-entered. Next, we're looking at the income and expenditure statement. The income and expenditure statement presents the result of a business operations for a given accounting period. It also contains information regarding turnover, income and expenditure, and losses and gains for the period under review. It summarizes the income and expenditure items influencing the equity of a business owner during the period concerned, and it determines the net income or profit or loss of the enterprise for a period in question. The income statement shows an accumulated net income or a deficit brought forward from the previous accounting period, appropriations made to and from reserve accounts, amounts distributed to the owners of the enterprise, and any amount of retained income to be carried forward to the next accounting period. The income statement starts by listing income or revenues. Direct costs or the cost of the goods and services sold are deducted from the revenue to determine the gross profit of the enterprise. Operating or general expenses such as rental, advertising expenses are then subtracted from the gross profit to determine the operating profit. Operating costs tend to be fixed. For example, rental payable for the hire of a business premises is usually fixed for an established period in terms of a lease agreement. Operating costs are also not directly tied to any specific sales or service transactions. Non-operating and extraordinary items such as interest expense and income taxes are then subtracted to arrive at the net income. Next, we focus on income. Income refers to the cash inflows into an estate agency enterprise from the rendering of estate agency services during the period. Monies earned by the enterprise, even if not yet actually received, are included in the income as income and expenditure statement measures profitability, not cash flow. Next, we look at expenditure. Expenditure refers to the cash outflows or the incurring of liabilities by the enterprise arising from the rendering of estate agency services during the period. Expenditure thus refers to the cost incurred by the enterprise. All expenditure incurred within the relevant time period is taken into account if those debts have not yet been paid by the firm. At the end of the period covered by the income and expenditure statement, the expenditure incurred is subtracted from the income made to determine if a profit has been made. Next, we look at an example of a simple income and expenditure statement. We'll call this income statement of ACE Estate CC for the period ended 31st of December 2017. First line item, revenue, gross profit, expenses, for example, advertising, bank and credit card, bookkeeping, employees, entertainment, insurance, legal services, licenses, postage and stationery, rent, electricity, all those expenses totaling 194,512. That deducted from a gross profit of 496,397, resulting in a net income of 301,885. In the example of ACE Estates, it should be noted that income received for the period was 496,397, while the expenditure incurred amounted to 194,512. ACE Estates CC showed a profit of 301,885 for that period. If, however, the expenditure incurred by ACE Estate CC had exceeded the income earned, the enterprise would then have made a trading loss for the period. Next, we look at financial viability, the going concern principle. Financial statements are based on an assumption that the enterprise is a going concern in that it will continue to operate for the foreseeable future, but at least for the next 12 months. Is sufficiently profitable either now or at some future time to continue operations, and has an inherent worth in continuing with its operations. The going concern principle relates to the ability of an enterprise to continue functioning. When preparing the financial statements, the owners of the enterprise must assess whether the going concern assumption is appropriate. The enterprise, as a going concern, is able to realize assets and discharge liabilities during the ordinary course of business operations. Persons examining the financial statements to determine the financial viability of an enterprise will usually also analyze the inherent worth of the enterprise. If a fundamental analysis of the enterprise is required, they will not only look at the single trading, but will also wish to examine many years of operational results. The balance sheet is a statement that reflects the financial position of an enterprise in terms of an investment in assets, liabilities, and owner's equity at a particular moment in time. The financial position of an enterprise is described in the balance sheet at a specific time and with reference to the following: the assets belonging to the enterprise at that time, the liabilities of an enterprise at the time, and the difference between the assets and liabilities or the net worth or owner's equity in the enterprise. A balance sheet comprises of three parts: assets, liabilities, and owner's equity. The main categories of assets are generally listed first, followed by a listing of liabilities. The difference between the assets and the liabilities is the equity or the net assets or the net worth or capital of the enterprise. The balance sheet heading indicates the name of an enterprise and the relevant date. While the income statement covers the financial year of an enterprise, the balance sheet reflects the financial position of an enterprise on the last day of the year under review. The basic form of a balance sheet is based on an accounting equation: assets equals to liabilities plus owner's equity. The two sections making up the balance sheet, namely the capital employed and the employment of capital sections, reflect this accounting equation. Capital employed represents the owner's equity section, while the employment of capital section comprises assets minus liabilities. The capital employed section of the balance sheet indicates the amount of money which the owner of an enterprise has put into the undertaking or the investment that has been made by the owner in the operation. Capital employed generally consists of the share capital of business if that business operates as a company. In other forms of trading operations, such as sole traders or partnerships, the capital employed section of the balance sheet reflects investment of the sole trader or partners in that enterprise. Share capital refers to the equity of an enterprise, a company incorporated with an authorized share capital divided amongst the shareholders or the owners of the business. In a public company, these shares can be bought or sold and reflect the division of ownership and of profit sharing in that company. A person owning shares in a company is entitled to share in the profits of the company in proportion to the shareholding held in the form of dividends payable by the company in respect of each share held. A company is not forced to declare dividend and might wish rather to retain the profits to advance the objectives of the company. The board of directors of the company decides whether to pay profits to shareholders in the form of dividends. Now let's look at employment of capital. This is the section of the balance sheet that shows what has been done with the money that the owners of the enterprise invested in the undertaking. The difference between a person's assets, in other words, what the person actually owns, and the person's liabilities, what the person owes, represents the net worth of that person. Net worth is also referred to as owner's equity. Thus, net worth or equity equals to assets minus liabilities. The net worth is that portion of the assets over which creditors have no claim and which represent the interest of the owner in the assets. The net worth of an enterprise is the difference between the value of the assets and of the liabilities of the enterprise. The owner's equity can also be considered to be the extent to which the owner finances the assets of that enterprise. Let's look at the contents of the balance sheet. First, assets divided into current assets, for example, cash and cash equivalents, inventories, accounts receivable, prepaid expenses. The other category being fixed assets, such as property, plant and equipment, investment property, intangible assets, financial assets. Next, we look at the liabilities, such as accounts payable, financial liabilities, liabilities and assets of the current tax due, deferred tax liabilities and deferred tax assets, and the equity side. This represents the number of shares authorized, issued, and fully paid. Number of shares authorized and issued but not fully paid. Par value of shares, the reconciliation of shares outstanding at the beginning and at the end of the period. Next, we look at the notes to the balance sheet. The notes enable the disclosure in the balance sheet of the necessary financial data and the accounting information required by either the legislation or for a full and proper understanding and interpretation of the balance sheet. The notes explain or supplement information furnished and or provide additional information which cannot appropriately or conveniently be included in the balance sheet itself. Notes and supporting schedules form an integral part of the balance sheet and are also covered by the auditor's report. There might be, for example, a note of the balance sheet showing how fixed assets were depreciated in accordance with the straight line method and how the depreciation figures were calculated. Other matters referred to in the notes could also include, for example, particulars of encumbrances on the assets of the company to ensure the liabilities of any other person and details of the amounts so secured. The general nature of other contingent liabilities that have not been provided for, as well as the estimated amount of these liabilities, and an aggregate amount of contracts for capital expenditure. Next, we look at analyzing of the balance sheet. Analyzing a balance sheet is an invaluable tool in understanding the net worth of an enterprise. The enterprise can be evaluated and appropriate investment, credit, and other financial decisions made accordingly. Assets. Assets refer to the economic resources owned by an enterprise which have measurable value. Assets are normally acquired by an enterprise through an investment of available funds. It is expected that the assets will provide future benefits to the enterprise through their use in the business operations and trading activities. Let's look at depreciation. The value of a fixed asset is usually written down over a period of time by calculating the depreciation of the asset. Depreciation refers to the reduction in the value of an asset over time due to such factors as usage, age, wear and tear, technological obsolescence, depletion, inadequacy, rot, rust, and decay. Depreciation describes any method used to attribute the purchase cost of an asset over its useful life and corresponds to the anticipated wear and tear of the asset in question. Depreciation is more relevant to fixed assets, having a short or a fixed lifespan of a service life. Depreciation affects the financial statements of an enterprise in that it causes an expense to be recognized and lowers the stated profits as reflected on the income statement. The net value of the assets will, of course, also show the decline on the balance sheet. Liabilities. Liabilities refer to claims against the combined resources of the enterprise or debts which the enterprise owes to its creditors. Long-term liabilities. Liabilities are long-term if they are not due for payment by the enterprise within 1 year of the date of the balance sheet. The following information in respect of long-term liabilities is disclosed on the balance sheet: the amount of any loans that have been made to the enterprise, the rate of interest payable in respect of such loans, the dates when such loans are due for repayment, and if the loans are repayable in installments, the amount of each such installment. The long-term liabilities of an enterprise are reflected in the capital employed section of the balance sheet. Long-term liabilities will include, for instance, a mortgage bond registered over property purchased by the enterprise, monies borrowed by the enterprise against security of a debenture. Next, we look at current liabilities. Current liabilities are the debts or obligations of the enterprise which must be settled within 1 year or within the normal operating cycle of the enterprise if that operating cycle is longer than a year. All current liabilities must be summarized in such a way as to clearly disclose the nature of those current liabilities, including the total amount of any bank overdrafts, the total amount of any current loans, including whether those loans are secured or are unsecured. Details of any dividends declared or recommended, information concerning the liability for payment of income tax. The largest portion of current liabilities appearing on the balance sheet of a trading enterprise comprise accounts payable, including trade and other liabilities, as well as tax due and payable. Now let's look at the difference between solvency and liquidity. The financial strength of an enterprise is a function of both solvency and liquidity. Solvency is concerned with the excess of assets over liabilities, as well as the financial ability of an enterprise to meet all of its debt and other financial obligations. Liquidity relates to the ability of an enterprise to meet its short-term liabilities and, by so doing, retain its creditworthiness. An enterprise may be solvent but liquid. Next, we look at the cash flow statement. The cash flow statement is a financial statement which highlights the changes that took place in the financial position of an enterprise during the accounting period under review, with special reference to the manner in which changes in both balance sheet and income statement might affect cash and cash equivalents. It assists in measuring the ability of the enterprise to cover its expenses in the short term and analyzes aspects of the enterprise that might otherwise not be apparent from either the balance sheet and the income statement. It does so by summarizing additions to the financial resources of the enterprise during the period under review, showing how these resources were applied by the enterprise, as well as the effects of any financing and investing transactions not directly involving the cash flow of funds. The cash flow statement analyzes the operating, investing, and financing activities of the enterprise to indicate why the financial position of the enterprise has changed since the previous balance sheet. The cash flow statement links and makes sense of the two successive balance sheets. The cash flow statement is an important reflector of the liquidity of an enterprise, and it's useful in determining the short-term viability of an enterprise, its ability to settle liabilities as they fall due. Generally speaking, an enterprise is considered to be of good value if it is able to consistently generate more cash than it spends. The cash flow statement includes only inflows and outflows of cash and of cash equivalents while excluding transactions not directly affecting cash receipts and payments. It is a cash basis report on the operating, investing, and financing activities of the enterprise. The cash flow statement is divided into three parts, namely operations, investing, and financing. The cash flow generated by operations refers to the amount of cash an enterprise generates from revenues, excluding any costs that are associated with long-term investments on capital items. Thus, operating cash flow equals to cash generated from operations, less taxation and interest paid, investment income received, and dividends paid. To calculate cash generated from operations or core business transactions, it is necessary to calculate the cash generated from customers as well as cash paid to suppliers. The difference between the two amounts reflects the cash that was generated from operations. Cash generated from operations refers to earnings before interest and taxes plus depreciation minus taxes. Cash generated from operations is often a better indicator of liquidity than earnings, since non-cash earnings cannot be used to settle accounts. Many enterprises prefer to invest funds outside of their core operations or diversify their operations by acquiring new enterprises. This section of the cash flow statement accounts for cash utilized by an enterprise in making new investments as well as for the proceeds of the previous investments. Cash generated from financing refers to the movement of cash from the financing activities of an enterprise, such as, for example, the taking of a new loan or issuing of shares to new investors. It also refers to the payment of dividends to current shareholders. Cash generated from financing is calculated as the cash received from the issue of shares, less dividends paid, less cash used for the acquisition of shares. The final step in the analyzing of the cash flow position is to add the balances from the current and previous reporting years. Let's look at the objective of the cash flow statement. It provides information on the liquidity and solvency of the enterprise, including its ability to change the cash flows in the future circumstances, provides information to evaluate changes in the assets, liabilities, and equity of an enterprise, improves the comparability of the operating performance in different enterprises by standardizing accounting methods, and it indicates the amount, timing, and probability of the anticipated future cash flows. It also contains the information on the sources and application of the funds received and applied by the enterprise during the financial period under review. This it does by showing the source of those funds and resources and how they were used by the enterprise. Thank you. That brings me to the end of the presentation. Please remember to answer the 10 multiple choice questions to obtain your 5 verifiable CPD points for this session.